Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement. I want to thank everybody for joining us this weekend. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Yes, we are independent. We are a registered investment advisor, and I want to thank everybody for listening. We see the radio podcast numbers, and they're certainly going up and to the right. If this is the first time you are hearing us, welcome. We are an advisory firm that believes that you can make money even in down markets. We believe the markets can go up, they can go down, and they can go sideways. We want to deliver positive return strategies that can deliver positive returns in all of those markets. If you are considering talking with us, you can certainly give Paige a call, 630-492-1912, 630-492-1912. If you're hearing my voice and you are outside of the Chicago area, understand that we can work with you. We do continue to expand the radio show and its stations, and we're really happy to do that. So structured notes, bank notes, income notes. We continue to do many income notes. We are towards the top in the Chicago area, and what that means for you is better pricing. So better pricing. We did just price another bank note, income note this past week. The bank was one of the top banks in the world, and it paid 12.5% annually as long as the indexes that it was following did not drop 25%. So again, past performance is not indicative of future results. There's certainly other considerations that you have to go through, but getting 12.5% rather is something that appeals to you as long as the markets don't drop 25%. So 12.5% with 25% downside protection. Then give Paige a call, 630-492-1912, 630-492-1912. The tax strategy is absolutely phenomenal, so we're getting a lot of interest in the income banknotes and in the tax reduction strategies. So if you want something like that, a strategy that can provide distributions independent of the stock and bond market in the 15 to 20% targeted range, then give us a call as well, 630-492-1912. Let's get to the market. Markets are volatile. I think volatility is here to stay, especially going into an election year, because the markets, obviously if the markets are down, you have the opportunity to continue to add money, and losses do not hurt. We want to stress again that if you lose 20% of your money, the next 25% of your gains will just go to get back to even. And when you're near retirement or in retirement, that is and can be painful. If you're in retirement or near retirement, you have to ask yourself, what does 100 years worth of data really mean? I think it's a good data point, but I don't think it's anything that should make you feel comfortable with your strategy that you have in place. Again, when we are working with or talking with new potential clients, I really want you to sit and think and ask yourself, that the markets drop 20%. Do you have anything inside of your portfolio that can still deliver double-digit returns? If you do not, then we need to talk. And we need to talk because of the following statistic. Well, following two statistics. Again, when you hear market averages and you hear long-term averages, of course the markets go up over time. That's not a debate. That's not a question. But the markets can stay flat. Investments can stay flat to sideways for an extended period of time. That is my concern. The markets, just go back to Microsoft. If you bought Microsoft in 2000, it took you to 2012 just to get back to even. So what does that do to your portfolio? Yes, we had the .com. Yes, we had '08. But that isn't, 60 years ago. It's not the Great Depression. Look at where valuations are at today, and valuations are stretched. And that leads me to one of my favorite statistics that when I read it, I just could not wait to get on the radio show, and I'll probably talk about this multiple times today. And it really references valuation, and we'll get to how far and fast will the Fed cut rates, because that's something that I want to talk about here shortly. But if we look at valuation in every area of life, we understand what valuation is. We want a deal, and it's really simple. Whether you're buying a house, whether you're buying a car, whether you're buying clothes, whether you're buying food, it's very easy for you to figure out if it's a good deal or not. But when it comes to the market, it's like this black box, right? Everybody thinks the markets are always fairly valued, always invest. Just put money in, put money in, put money in. And that's, an inaccurate statement. I do think, or an inaccurate thought process, in our opinion. I do think that you have to craft portfolios that can do well, again, when the markets are up, down, or sideways. And so we will look at portfolios distinctly different than many, i.e. the income notes. How many advisors are bringing you bank notes, income notes backed by the largest, most secure financial institutions in the world that are relatively short-term in nature and can give you, well, the one we priced this week and traded this week was 12.5%. You got that 12.5% as long as the indexes that note was tracking were not down 25%. Think about that. So if the markets are down, we still have money in the portfolio that is making money. So here's the statistic on the S&P 500 I found fascinating this week. Why did the S&P 500 total return lag T-bills from 1927 to 1947, 1968 to 1985, and then 2000 to 2013? Okay, the answer, I'll give it to you in a minute. Why did the S&P lag Treasury bonds from 1929 to 1950, 1968 to 1987, 1998 to 2020, and then 2007 to 2020? The answer is very simple. Valuations, extreme valuations. So we're not trying to time the markets here. We're not trying to forecast the markets here. It's really simplistic. The markets are extremely valued. When you look at valuations, now certainly valuations can be the markets can become more overvalued, but so much of your success in retirement, or really investing rather, is where are we when the markets, where are we at in the markets? And unfortunately, with the individual investor, they want to wait. They want to wait until the markets go up to put money to work. They never want to play defense. They never want to realize gains. And that's, unfortunately, why individuals consistently track the market up and down. And that is something that we want to make sure for our clients, that when we construct a portfolio, that we have strategies in place. Yes, that will track the market, of course, 100%, no doubt about it. But that we also have 20%, 25%, 50%, whatever that number is, that's obviously personalized and tailored to you and your individual situation, but that can still make money when the markets are down. That is the single greatest question to ask an advisor that you're currently working with. Show me. Don't tell me. Don't walk around it. Don't dance around it. Show me. Show me in my portfolio what will do well if the markets are down. If you do not have that in your portfolio, then you're leaving too much to chance. And we do. And one of the reasons that I continue to stress this, a question that we keep getting asked, especially in the market, is this the biggest concentration bubble in the history of the markets? Now, when we talk about concentration, we often talk about the Magnificent Seven. Obviously, we've talked a lot about that on the radio. The seven, just Google Mag 7 stocks, and you'll be able to see that. Currently, at least as of middle of last week, it accounted for 32% of the S&P 500. Think about that. 7 stocks accounted for 32% of the S&P 500. That is near an all-time high. It's actually 10 percentage points higher than in the 2000 dot-com bubble. So you just really need to stop and think about that. So what is driving this market? Well, it's been phenomenal. We love, I would look at that kind of as leverage, right? We love leverage when the market's going up. We hate leverage when the markets are going down. And so you must really stop and think, what is going on in the world? What is going on in the markets? What is going on geopolitically? When we look at interest rates, what happens and why are they cutting interest rates? Well, if they're cutting interest rates, well, they say that inflation is down. Not according to my family, not according to my wife, not according to myself, not according to my kids when they go to Chipotle and they say, my goodness, I'm hearing it from them, the burrito cost X. I mean, I love Chipotle, but, inflation is really just, still very, very rampant. I look at energy, I look at healthcare costs. I mean, I don't know if your inflation is down, please reach out to me because I need to know what you're doing and I can enact that because in my opinion, it's not. And so if the Fed is cutting rates, whether it's 25 basis points, whether it's 50 basis points, which is just a quarter of a point or a half a point, that has to tell you something. That has to tell you that the economy is slowing. The economy is slowing greatly, and that is a very, very big concern of ours. It's something that we want to make sure that we are protected against. We want to make sure that we still have the ability to make money. And I love it. I love it. Everybody tells me don't talk about the banknotes on the radio. Don't talk about the energy strategy on the radio. When we do our dinners, we do dinners throughout the Chicagoland area. We're just different. My job isn't to sell you something. My job is to provide. Yeah, it is. My job is to sell you something. It's to sell you the idea that you don't have to lose money. It's to sell you the idea that there are strategies in the marketplace today that were once unattainable to the average investor, now are attainable to, well, if you have $1,000, they're attainable for everybody that can deliver positive returns to a point in negative markets. And that is what I'm trying to sell. And you know what? When we look at who has reached out, when we look at, over the last 6 months, because we've been doing the radio show for forever, I love it. I love the fact that people are reaching out asking, hey, what about those income notes? Hey, I want to know how I can make money when the markets are down. Now, again, we don't put all of our eggs in that basket, of course. I mean, when we look at portfolio diversification, we call that our protected growth bucket. But we also want growth. We also want aggressive growth, and we also want tax and tax reduction and alternatives. And I think that's when I know, at least it's my belief, that you have a very good portfolio. And if your advisor cannot show you, don't tell me, show me. Point to something in my portfolio. You got 100,000, you got 10 million. I don't care what that number is. Show me what I have in my portfolio. Show me on my statements, log in, do a screen share, whatever. I want to know what can deliver positive returns in negative markets to a point. If you don't have it, we need to have a conversation because you're leaving too much to chance, and that's not good, especially in this market, because it's really simple. The less you lose, the more you gain. So you're listening to Destination Retirement. After the break, I want to talk about interest rates. I want to talk about the Fed, if they'll cut rates, how far they'll cut rates, and we'll go over that. So 630-492-1912. Give Paige a call. Let's have a conversation. 630-492-1912. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary. If you're listening to my voice, if you can hear this radio show, we do run the radio show in multiple markets, so understand that we can work with you. We are headquartered in Naperville, but we do have Naperville, Illinois, that is. But we do have a national client base, and we love that fact. We love that people are not defined on who to work with just because of where you live. So we talk with many, many people outside of our home market. Don't know this to be fact because I haven't looked at the numbers, but I'd say 30% of our clients, 40% of our clients are outside of our home market. And with Zoom and with the amount that we travel, we absolutely love it. So if you have any investment-related questions, if you cannot point to something in your portfolio, if your advisor cannot show you something in your portfolio that can generate positive returns in negative markets, reach out to us and we'll show you how we can do that. 630-492-1912, 630-492-1912. The banknote we priced last week paid 12.5% annually as long as the index it tracked were not down 25%. So a better way to look at that is you had 25% downside protection to make 12.5%. So if you want to learn more about that, make sure you reach out. Our tax advantage strategy, if you sold a business, if you sold a building, if you're a high wage earner, we definitely need to talk about that. financial planning is top of mind always with us. We think we take it to a level that most advisors don't. But again, tax planning is the most overlooked area of that financial planning process. If you're working with a big bank or a big brokerage firm, understand there's very little to no proactive tax management. So if you'd like to reduce your taxable income, well, I'll give you an example. Last year, had you invested in the KCP Energy Fund, you reduced your taxable income almost $90,000 for every $100,000 you invested. And yes, that's active, that's passive, it's 1099, W-2, capital gains. So if you want to learn more about that strategy and go over what it is, what it's not, and see if it could make sense for you, let's certainly have that conversation. 630-492-1912. 630-492-1912. Okay, interest rates. So the big question, September 18th, what is going to happen to interest rates? Well, if you listen to the radio show in the last couple of weeks, you understand that these are very interesting times. If we go back to what happened in 2007, the markets dropped, we recovered, then they cut rates, and then the markets crashed. Well, very, very similar where we're at. And that they actually raised rates cut rates on the 18th back then as well. So here we are, markets were down, markets recovered. Now what's going to happen with the Fed on September 18th? We think the rate cut is in the cards, albeit I don't know why, given inflation, but that should tell you something about the underlying economy. Maybe it's not as strong as we all think it is. So I think when you look at how far and fast will the Fed cut rates, investors are hoping for swift and steep rate cuts. But those investors, I think, are going to be disappointed. If you look at what this U.S. central bank prepares to do, they're certainly, if they've telegraphed it, that they're going to lower interest rates for the first time in more than 4 years. You have to understand, if they lower interest rates, there's an issue because inflation, I know they say that it's coming down significantly. I just simply don't agree with that. That's just how we live our lives, which is why I don't agree with that. So if you look at what's going on in interest rates, I think they're cutting rates because the world is slowing, and it's slowing a lot faster than many people have expected. And that's okay. I mean, again, we don't want to look into our crystal ball. One of the beautiful things about our clients is we still have money, even if the markets drop. We have strategies in our portfolio that will protect your principal investment and also strategies that can make money. If you don't have it, we need to have a conversation, because if we look at what's going on in interest rates, a couple of key takeaways that we have had in the, with what is going, where or when, the Fed cuts rates, I think we're going to have slow and shallow rate cuts. I think that would be more consistent with an economic soft landing. We've talked a lot about soft landing, hard landing, medium landing. I don't necessarily understand what that is. Kind of like I don't understand what a moderate aggressive investor is, or an aggressive investor is, or a moderately conservative investor is. Again, we talk a lot about, we go down a lot of these rabbit holes. And if you're still working with an advisor that determines your risk tolerance based on 8 to 10 questions, and that's how they construct portfolios, you're probably not, and you definitely, at least it's my belief, you do not have the most proactive risk management strategies in place. Now, that being said, we still do those risk tolerance questionnaires. I mean, it's online. We think ours is one of the most proactive in the industry. But again, it's just a gauge. It gives us an idea of how you look at, in my opinion, it's more how do you consider volatility? How do you deal with portfolio volatility? So certainly don't construct portfolios in that way, because I think every investor, if there's opportunity, should be aggressive investor. I think every investor, if there's significant risk, no matter what your age, I think you need to be a very, very conservative investor. My grandson is 2 years old. We have our second grandson on the way. That doesn't mean, and my youngest is 11. That doesn't mean that, just that it's okay for them to lose money just because they have a long time horizon. I mean, again, it's simple math. If we lose less, you have to make up more. You lose 20% of your portfolio, you're going to waste the next 25% of your gains just to get back to even. So think about that. 20% downside, 25% of the gains are going to be used to get back to even. So when we look at, obviously interest rates, it'll certainly be an interesting week next week. But if recent labor and economic and financial markets, they certainly have signaled, if you look at the signals in the labor market, in the economic and financial market, they've been mixed at best. And I think that's warranting a cautious optimism from investors. That is, it's kind of like, we have a presidential election. If your president that you hope gets in doesn't get in, well, I guess the next thing is you want a split government. So you have, Republicans in Congress, Republicans, in the House, and maybe Democrats in the Senate, or vice versa. So, when you look at some positives, some negatives, that generally isn't the worst thing. But I think what many individual investors are being advised to do is to focus on maximum portfolio diversification and consider owning an equal-weighted version of benchmark U.S. stock indexes, as well as investment-grade credit and non-U.S. assets. That's the basic, think about that. That is just the going stock recommendation. And it's so frustrating to me because let's just go with, okay, we own diversified equities, but you still own equities. It doesn't matter. It's still an equity. Small, mid, large, growth, international, emerging markets, et cetera. It's still an equity. And then you have fixed income. And, look at how that's done for you. Well, it should have done well for you over the last month or two, but look at how well that's done for you over the last, 4 years. But that's the basic stock allocation recommendation from advisors. And I think it is because that helps them scale a business. It's easy to implement at scale, so the advisor's income goes up. It's my belief, and I believe this wholeheartedly, just because I know a tremendous amount of people in this industry, advisors that is, that they are investing their personal money different than they recommend for clients to invest their money. So owning equities and bonds is not diversification in any way, shape, or form. Show me, an energy strategy. Show me a strategy that can deliver returns independent of the stock and bond market. Show me a strategy that has a defined outcome strategy, that the question, or the downside going in, like the bank notes. That the bank note we priced this week, that you're going to get 12.5% as long as the index that note follows are not down 25%. That, we look at diversification totally different, totally different than the average advisor. So yes, the time has come for interest rates to be cut. At least that's according to the Fed chair, Jay Powell. That's his message. That's the message that he gave at the annual Jackson Hole Economic Symposium in late August. And with that, I do believe the Fed appears all but certain to cut interest rates for the first time in more than 4 years on the 18th. So, the approach, I don't know if it's going to be a half a point. I don't know if it's going to be a quarter point. But the approach may disappoint investors who are hoping for deeper and faster cuts that push the policy rate below 3%, which could potentially support higher equity valuations. However, the S&P 500 is already richly valued, and if you look at Wall Street's consensus earnings forecast, I think they look ambitious. That is concerning. So given that economic outlook, I think growth is likely to cool. As such, we may see the markets drop. We may see the markets trade sideways for an extended period of time. And, my job as an advisor is to not predict the market. It's not to look in my crystal ball. It's not to go with my gut feel. It's really to make sure that when we construct your portfolio as your client, first and foremost, that we have your income needs met. Some people, again, one of the beautiful things about working with us is whether you have $100,000 or $20 million of investable assets, the strategies will certainly change. There's no doubt about that. It's just a fact of life. The more money you have, the more access you have to strategies. But that's not my rules. That's just the rules of the SEC. But, our job is to really make sure that we're constructing a portfolio that can generate income that you need. Some people don't need income. We've met with people who have $500,000 and they don't need income. They can just live off of Social Security, live off a pension, and they are in that, they're afforded that luxury that they don't need income. And the flip side to that is we've met with people who have $5 to $10 million of investable assets and they absolutely need significant income. And so I think the role of an advisor is to make sure that when you construct portfolios, it all starts with the plan. First and foremost, it all starts with the financial plan. It all starts with probability analysis. It all starts with How much income do you have? What are my resources? What are my income sources? Are they guaranteed? Are they not guaranteed? And then let's look at randomized market-generated scenarios and give you a probability of success that you'll be able to meet those goals in retirement through your life expectancy. So our belief has always been in constructing portfolios that volatility doesn't really bother investors. Where it bothers investors is if they don't have the money to weather a 2 to 3 year down market. That's the challenge, because if you let the markets work, the markets inevitably always come back. Now, like I said earlier, if you bought Microsoft in 2000, it took you 12 years to get back to even, but we have to look at portfolio construction differently. The goal of an advisor, in my opinion, you have to be a master asset allocator, and that's what we consider ourselves. And when we look at constructing a portfolio and we look at income planning, again, whether you need income, whether you don't need income, the goal is to make sure that you have enough income generation, whether the markets are up, down, or sideways, to last you through uncertain periods. And an uncertain period may be 2 to 3 years. That just is what it is. The markets can, and they do, go down. And, well, maybe they haven't, and maybe it's a God-given right that the markets will never go down again. Maybe the Fed will do everything they can to continue to prop up the markets no matter what. But again, I think that just creates bubbles. I think that creates more uncertainty. And, what it does for individuals is it does two things. It keeps a lot of people out of the market. I can't tell you how many investors that we have talked with throughout, the months, the last quarter or 2 or 3 or 4, in that they have just missed out on so much of this growth. They're, either themselves or their advisors, they were just like, well, the markets have to correct. The markets have to go down. Well, this, the markets don't have to do anything. What I think the markets should do, or what I think my gut tells me, is completely as irrelevant as what your gut tells you. It just doesn't matter. And unfortunately, when I think the Fed has created, or the government has created, these boom and bust cycles, it's just done more harm than good, and it's kept a lot of people out of the markets. They're content with 5.5% money market rates. While that's good, relatively speaking, it's not good after taxes and inflation. So a lot going on, but next week is going to be very, very interesting. We think volatility is here to stay. We think it's going to pick up significantly, maybe to the tune of what individuals haven't experienced in years and years and years, and we have to plan and manage for that. So 630-492-1912, 630-492-1912. Give Paige a call, set up a time for us to have our initial consultation, and we'll do all we can to help you. More after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, KuhnCP.com.
You're listening to Destination Retirement. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm, and yes, we are fiduciary. We do believe in financial planning. We do believe in risk mitigation. We do believe in defined investment strategies, defined outcome investment strategies, rather. Strategies like the bank note that we did last week. The bank note was 12.5%, so that's a really strong rate of return. 12.5% of return backed by one of the largest financial banks in the world, that you were able to receive 12.5% as long as the indexes it tracked were not down 25%. So a better way of saying you had 25% downside to still make 12.5% on the upside. Significant, proactive, risk-managed strategy. If you do not have strategies like that in your portfolio, if you do not have tax-managed strategies that can greatly reduce your taxable income to the tune, last year, had you invested in the KCP Energy Fund, it reduced your taxable income by almost $90,000 for every $100,000 you invested, targeted distributions 15 to 20%. If you'd like to review all of those docs, go over the risks, go over the rewards, let's have a conversation. 630-492-1912. 630-492-1912. Again, if you're listening to the radio show outside of our home market in Chicago, just outside of Chicago, Naperville, Illinois, then understand that we can work for you, work with you, work for you, etc. So if you're hearing my voice, know that we can work together. 630-492-1912. I want to thank everybody for reaching out. We've had a lot of longtime listeners over the last 3 to 4 weeks that have reached out for the first time. And I think I know why. Volatility is back. Volatility is, I don't think we've seen anything yet, but volatility is back. And when we see that kind of market, generally our phone starts ringing. And my goal, I think, is to always sell you ideas. Always sell you ideas. That is all I'm here to do. Sell you ideas to get you to think about strategies that can deliver positive returns in down markets. Again, it's simple math. Market's down 20%. The next 25% of your gains are going to go to just to get back to even, get your portfolio back to even. And that is an issue. It's an issue that we haven't had to deal with lately, but I think it's an issue that's going to come back, and it may come back in a way that we have not experienced in the past. And that's okay. I'm fine with that. I like it, actually, because it just shows the value of a good advisor versus a value of an average advisor. And I believe, it's my belief, that advisors manage their own personal money, their own family money differently than they recommend clients to manage their money. Most investment advisors are looking at basic cookie cutter strategies, asset allocation strategies between equities and bonds, because it's easy to sell, it's easy to scale, it's easy for them to increase their income. And then the answer when the markets are down is time. Don't worry about it, it'll come back. Don't worry about it, it'll come back. The markets have averaged 9%, 10%, etc. Well, that's over 100 years. What about in 2000? If you bought Microsoft, it took you 12 years to get back to even. That is why T-bills, T-bonds, there have been long periods of time that those fixed income strategies have outperformed the S&P 500. Why? The starting valuation of the S&P. Valuations are high. So when we look at how do we protect your retirement from market volatility, isn't that the job, I think, of every advisor? Protecting your retirement from market volatility. That, to me, is the goal of everybody. And if you ask your advisor, show me, where if the markets are down 25%, this investment will still make 12.5%. If they can't point to something that has a defined outcome, a total defined outcome, purely mathematical. Again, we do bank notes, income notes from the biggest banks in the world, JP Morgan, Citigroup, UBS, Bank of America, Morgan Stanley, Goldman Sachs, etc. If they can't point to a strategy like that can deliver, that's predefined, it's a prospectus item. So you get a prospectus that clearly states if this happens, this is your return. If that happens, this is your return. If you do not have that inside of your portfolio in this market for 20%, 30%, 40%, 50%, whatever that number is, then you're working with an advisor that is not sticking with the times. And again, most advisors, don't use banknotes, and I know why. They're very labor intensive. Used to have an extremely high minimum to get to them, so most advisors didn't start in the business using the banknotes, and they just won't do anything mid-career that's going to add more work, and it's unfortunate. And almost every client we talk to, every investor we talk to, will say, why hasn't anybody showed me this? Why doesn't everybody do this? And again, it's knowledge, and it's just knowledge, and it's lack of proactive risk management from advisors. So there is unpredictability. Let's talk about the unpredictability. But if you do want to learn more about the banknotes, if you want to get on our pricing list, because we do these at scale, what that means for you is we get better rates than most everybody else, just simply because of the volume that we commit to the banks. And they like that. The more you give, the better the rate you're going to get. 630-492-1912. 630-492-1912. So let's talk a little bit about protecting retirement from market volatility. 95% of what advisors say is going to be the exact same. They may, spin it a little bit differently. They have, maybe, some advisors may be more polished in telling their story than others. But 95% of what advisors say are going to sound very, very similar. But it's at 5%. It's at 5% of here is what we do that is different, that is going to have the greatest impact on your success, the greatest impact on how much money you may leave to your heirs, the greatest impact on how much money you can spend in retirement, the greatest impact of how much stress or peace of mind you're going to experience in retirement. So I'm going to challenge everybody out there. If you don't have anything inside of your portfolio that's predefined, that's a prospectus item that is going to show you that, yes, you can make money if the markets are down, you have to reach out, because the unpredictability of the financial markets can disrupt even the best laid retirement plans. That is something that we have always talked a lot about. We love financial plans. We love probability analysis. We love, doing these financial plans. Our financial plan, actually, all of our clients have access to those plans 24/7 through a website that connects to your overall plan. I don't, know how many people get on and look at their plan all the time, but you have the access to do that. We always want to use the plan as kind of a benchmark of checks and balances, because that's another thing I wanted to talk about this show. Investors don't know if they have a good portfolio or not. I mean, I ask somebody, do you have a good portfolio manager? Well, I mean, the answer always generally is yes, just because, if they thought no, they wouldn't work with them. But the second question that I ask is, well, how do you know? Because there's no clearinghouse that says, well, this advisory group is great. There's no clearinghouse where advisors report into for you to really judge. And so you're going on the word of an advisor. And the challenge is, unfortunately, who's going to say, yeah, I don't do well. Yeah, we don't do well. We don't have a bunch of good clients. We don't, our performance is generally, we underperform the market and our fees are high. Well, of course, they're not going to say that. And so the only way that I have been able to figure out if you have an advisor that is proactive, that is cutting edge, that is using the latest and greatest risk management strategies, again, that Wall Street is using, that advisors are using for their own money, is to simply ask an advisor, show me my investment that can deliver positive returns in down markets. And if they don't have it, then you have more of the same. And you owe it to talk to people like us so we can help you. 630-492-1912, 630-492-1912. Because the rule of thumb in volatile markets is to have patience. I don't like that. I just don't like that. I don't like it when advisors rely on 100 years worth of market data. I mean, who has 100 years? I have my second grandchild, and it happens to be a daughter, is born, scheduled to, due date is in November. So, I mean, she doesn't even have 100 years worth of time. And markets, she's not even born yet. So if you're in your 50s or 60s or 70s, I mean, do you have 100 years worth of market data? So when an advisor talks about averages, you have to kind of put that in context. My answer to them would be, okay, well, if you bought Microsoft in 2000, it took you 12 years to get back to even. So what does that mean, Mr. or Mrs. Advisor? So yes, we have to have patience, but more importantly, we have to have strategies in place that can still deliver positive returns when the markets are down. Because if you can ride out the markets up and down, prices eventually should recover. And that is true. Nobody is questioning that. Nobody, it's like when you talk about defense, when you talk about, investing today, like if you look at our aggressive growth strategy, I mean, that strategy has doubled what the S&P 500 has done. Well, it's actually more than doubled, almost tripled what the S&P 500 has done since 2015. Think about that. 3 times what the S&P 500 has done almost since 2015. Now, there's a lot of volatility, and volatility means there's a lot of ups, there's a lot of downs. But when you have a purposefully constructed portfolio that incorporates strategies that can deliver positive returns in down markets, you are not as worried about that 5%, 10%, 15% of the portfolio, because your income needs are met. And so, yes, I do get it that, the markets do recover, but unfortunately retirees don't always have the luxury of time. not retirees, but those that are, I always look at it kind of your late 50s, mid 50s to late 50s, 60s, et cetera. And then certainly into retirement, because if you are retired or you are approaching retirement, you may have to start to tap your investments for income. And when markets are volatile, potentially locking in losses, which means you have to sell investments to generate income, that can impair your portfolio for the long term. So, we have to look at, again, it's just, I like to think, well, I don't know. I like to think what we're doing is proactive, what we're doing is cutting edge, but we're not landing rockets, back on Earth. Okay. We're not. What we are doing, I think, is rather basic. Now, if you compare us to 100 other advisors, maybe we are the most cutting edge. Maybe we are utilizing institutional strategies that, individual investment advisors who, have, clients in the, a couple $100,000 to $10 million range aren't doing. And they're not doing it because they're labor intensive, they're time intensive, it takes employees to implement, et cetera, et cetera. But, we're not landing rockets back on Earth, okay? This is relatively basic stuff, at least in my world. So, yes, planning can go a long way towards helping you protect your retirement when market volatility hits. And there are a couple strategies that I think you need to consider. And when we talk a lot about that, obviously investing for income. Again, some people have, $500,000 investable assets and they don't need any income. They live a frugal life. They live a life that, they live within their means and they just don't need income from those assets. And that's great. Other, investors who have, multiple millions, they need a ridiculous amount of income because they live a crazy lifestyle. So everybody's all over the board. But at some point, many investors need to generate income. And the way to generate income has generally been to invest in bonds. And if you look at what interest rates have done, they've been very, very low. And if you look at what bond allocations have done over the last 4 years, short of the last handful of months, they've been awful. Maybe lose 15%, maybe lose 20%. And so again, we have to consider a different strategy that can still, kick off income. And the good news is there are strategies out there. There are strategies out there that if you need income right away, that we can get double digits as long as you're willing to take some market risk, that if the markets are down 30%, maybe you don't get a coupon payment that month, which isn't the end of the world, given the fact that, we're getting double digits just to start. And then there are other guaranteed income strategies that, can make some sense if you have some time to let your investments cook. So, when we look at market volatility, when we look at, kind of some strategies to just really kind of define a plan, there are things out there. And we'll talk about that after the break. And can you believe that the big wealth advisors are talking about annuities and consider purchasing an annuity? So we'll talk about that after the break. 630-492-1912, 630-492-1912. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, fiduciary independent risk management firm. We do work with advisors, or clients rather, throughout the country. So if you are hearing my voice, we are expanding our network of stations we are trying to continue to expand the network of stations that we run the radio show on, simply because of the response. We are selling something. Yes, we are absolutely positively selling something during this radio show. We're selling knowledge. We are selling knowledge that you can invest in strategies. Strategies exist that can deliver positive returns in down markets. Those strategies exist. We are also selling ideas that you can greatly reduce your taxable income. In the energy space, currently, we are afforded fantastic strategies in ways to reduce taxable income. 630-492-1912, 630-492-1912. If you want to learn more about those strategies, let's have that conversation. So, risk management, volatility. We started to talk about that last segment. To continue that now. So, I mentioned annuity. And the it's such a polarizing word. Investment shows on the radio, that's generally what they sell as annuities, because they pay a big commission, upfront commission. And it's okay to make money. I don't worry about that. But I think, unfortunately, when something pays a large commission, a lot of individuals advisors are going to use them when they shouldn't. And we see the lifetime income annuities used far too often when they shouldn't be. And in my opinion, it's my belief that if you want a guaranteed lifetime income annuity, you cannot touch that income for 7 to 10 years. 7 to 10 years. The way that you take advantage of the insurance companies, the way that you take advantage of these products, is if you have 7 to 10 years to defer income, then yes, there are maybe one lifetime income annuity that I would consider to be something to take a look at. And if that is you, and if you want to take a chunk of money and defer and not touch that money for 7 to 10 years and then turn on the income stream, it could be good, because we can see cash flow values in the arena of 10.5 to 12% guaranteed on your original investment, because that is where those annuities make sense. Unfortunately, I see far too many people selling these guaranteed lifetime income annuities, and they need the income in a year, or they need the income in 5 years. It's just not good enough, in my opinion, because the insurance companies, again, know actuarially that they give you just enough growth. They give you just enough growth to overcome your withdrawals, but so the account doesn't go to zero. And when you own these lifetime guaranteed income annuities, the only true benefit, I guess it has that sleep at night benefit, but the only true benefit is when the account goes to zero, then you're taking the insurance company's money. So that if you own a lifetime income annuity, please reach out to me and let's have a conversation, 630-492-1912. Because again, those annuity payments are fixed. Now, an advisor may tell you they can increase. They don't increase. They just do not increase. I can show you the sub-account returns of every single annuity, and it would blow your mind how low they are. So they're not going to increase. And so that's another thing you have to consider. You have to consider if you're getting a fixed amount for the rest of your life. And what is inflation going to do to that? So when we look at these lifetime income annuities, if you have 7 years to where you do not need to touch that money, really 7 to 10. So when you're in your 50s or in your 60s, maybe it could make some sense. And there is one that we can talk about that has some benefits that are very, very hard to match. That, on original investment, we can get to that 10 to 12%, generally speaking, cash flow rate on original investment because of the bonuses and the guarantees and whatnot. And they're pretty strong. And yes, you're going to deplete that asset to zero. But again, that's okay, because that's what we want it to do. And you're still going to get that cash flow for your life and maybe your wife's life if you decide to do a joint income strategy. So if you own a lifetime income annuity, please call me, 630-492-1912. Let's take a look at it. What we like to do, if you don't have 7 years to where you can let that money cook, but yet you want the protection, because there is let's face it, there is a lot of benefits of a annuity on the downside. And again, that falls into our kind of our protected growth bucket. We love a 5-year annuity. There's a 5-year annuity that is simply tied to the S&P. I would never do an annuity that's not only tied to the S&P 500. We've seen all of these illustrations. We've seen all of these fancy indexes, but that are new, that show these ridiculous rates of return, but they just don't deliver. I mean, when you have a volatility-controlled strategy, generally speaking, they're built for 4 to 6% over a 10-year period. 4 to 6% of return over a 10-year period. Newsflash, you can get that in a money market. You're not tying your money, your money up. So, what we're looking for is if we look at an annuity. And again, the annuity that we use, it's really more of a structured note, like kind of the bank notes, but it's offered by an insurance company. But there are a lot of people out there that would like the 5-year annuity that we use. It's very short term, 5 years, and it's only tied to the S&P. Currently, you get the first 9% growth of the S&P every single year. It literally is that simple. You get the first 9% growth of the S&P 500 every year. That's what the current rate cap is. That's pretty strong. There are a lot of people out there that would say, okay, if you can give me the first 9% with no downside, I'll take it. Okay, great. It's short-term in duration, and that might be part of the plan. The challenge is it shouldn't be all of the plan, but there's a lot of people in this market, in this world, in this economy, with this risk that they would like to know that my worst year is 0. So if the S&P is down 1 or if it's down 10, whether it's down 1 or it's down 50, my return is 0. A lot of people would like to know that. For that trade-off of that principal protection on the downside, you get currently the first 9% of the S&P 500 on an annual basis. And when you get that gain's locked in. So as we talked about earlier, the markets are down 20%. You have to get 25% to get back to even. Well, in this strategy, you don't have to do that. So there's a lot of people that would like that. And it's only 5 years. So we see far too many people buying these guaranteed lifetime income annuities that need the money before 7 years. If you need the money before 7 years, it's our belief, the math tells me, that it's just not going to benefit you. It just doesn't benefit you to buy that annuity. If you have 7 to 10 years, okay, let's compare and contrast whether we should do a guaranteed lifetime income annuity or a bank note that's going to pay you, double-digit rates of return as long as the markets don't drop 30%. So let's just do some compare and contrasting. And if you really need that protection and you want to take some of your IRA money, you want to take some taxable money that, because you're nearing retirement or you're in retirement and you are content with up to 9%. So for that cap, you get the first 9% of the S&P 500 growth. That's what the current cap is. You have no downside. And there's a lot of people that want that. And maybe it should be part of a plan. We would consider that to be our protected growth bucket. So the beauty about working with us is we have zero preconceived notions, absolutely none. Most people who are doing radio shows, they know exactly what they're going to pitch you before you even come into that office. It's like to a hammer, everything looks like a nail, right? That I see the numbers. I know who's doing what. And it always comes down to these guaranteed lifetime income annuities. And, they say, well, you get 7% guaranteed growth. No, you don't. Your income may grow at 7%, but not your real money. So long story short, if you own those, please reach out 630-492-1912 so we can have a conversation, so we can talk about what it is, because we also want to consider, again, we do sleeves, we do buckets, call it what you want. But we, if you look at time segmented buckets, I think throughout investors' lives, we usually or we regularly will use different, buckets to save for different goals. Funds we need to keep for near-term goals. Funds we need to keep for future goals. Funds we keep for, legacy goals. And I think when you look at constructing a portfolio that an investor can plan for early, middle, late stages of retirement by aligning those pools of assets in different phases and different strategies, you have, again, it's a very good plan. It just allows you to stomach some of that volatility. It allows you to not have to sell volatile assets when the market is down. Because, again, if you lose 20%, you have to get 25% just to break even. If you're taking income out, that number goes up exponentially. And so losses when you're drawing income, if you're just doing a distribution strategy, just dollar cost averaging out, I would be very, very, very worried about what you're doing in your portfolio. It's like when people retire, they forget about having, assets that can really grow, aggressive assets. And again, it may only be 5%, 10%, 15% of your portfolio. But as I mentioned, in our growth plus bucket, again, past performance is not indicative of future results. That is very, very critical of any time I reference any kind of performance, but it's almost tripled what the S&P 500 has done since 2015. Why in the world shouldn't you have some money that can really get after it? And yes, it's going to go up, it's going to go down. But if you have your income needs met, if you need them, in the near term, in the middle term, and in the longer term, you're not worried about that volatility. If you have a strategy in place that can still deliver positive returns in down markets, like the bank notes, 12.5% with 25% downside protection, as long as the markets don't drop 25%, the indexes that the note tracked, that's what you received. So a little bit over 1% a month. And if you have a strategy that is principal protected for some money, that can get the first 9% currently of the S&P 500 with no downside, then what do you care if that 10 to 20% of the growth plus money is up and down a lot? You just don't worry about it. And, the strategy that we use is mathematical. Again, we have access to managers that you don't have access to. We can get certain managers for minimums that you just simply can't get access to these managers. And when you look at a strategy that's averaged since 20%, that is huge. 20% a year. There's many years that it was up 80. Now, again, it can also go down. There was a year where it was down 35. There was a year that it was down 15. But if we position the remainder of your assets correctly, this you're not worrying about. And when we look at strategies like this that could almost double to triple the S&P, over the last 9 years, that's great. That it just is, I think the job of an advisor. But most advisors don't do it, but you know what? That's what keeps us busy. So a couple things, if you don't know, if you ask your advisor, show me what strategies I have in place that can protect principal in a down market or can generate positive returns in a down market to a certain point. If they can't show you on your statement, here it is, then you don't have it. And you owe it to yourself, you owe it to your family, you owe it to whoever you consider important that relies on you to reach out and start that conversation with us. So 630-492-1912, 630-492-1912. More next week. Hope everybody has a great week.